Hi everyone, welcome to Phillip Securities Research Monday morning call. We have stock counter updates from US big tech, namely Microsoft, Meta, Amazon, Apple. Philip on the ground from Lam Research. We have REITs update from Fraser Centrepoint Trust, Capital and Escort Trust, First REIT, MPAC, and we also have updates from SIA, Sheng Siong, Raffles Medical, and Keppel. We have our macro update, our technicals, as well as our usual Singapore Weekly. So before we start, the information provided is for educational purposes only. So without further ado, I'll pass on to Fahmi.
Hello everyone, good morning. Thank you, Hashim. So I'm presenting Microsoft. They released a result for the fourth quarter last week. Next slide, please. So the fourth quarter result met our expectation, while for the revenue, but the pardon me exceeded our expectation. So the revenue-wise grew about 18% ahead of the guidance by 3%. Strong guidance, strong number. Productivity strong at 14%, intelligent cloud strong as well at 15%. But big performance in the percent from at 4% because of the fall in the Windows and gaming at 7 and 10% respectively. Better margin, 21 basis point higher than it was in the same quarter last year, and the earning per share adjusted grew about 23% strong number, and excluding the minimal investment in the gain in OpenAI. So look at the remaining performance obligation. We see the order book, strong growth at 84%, then healthy growth at 26%. Even if you exclude the OpenAI commitment, it's still growing healthily from the enterprises at 26%. So looking at the positive point, the Microsoft Azure accelerate again. The growth now is at 43% this quarter and much higher than 40% in the previous quarter. And this particular growth has surpassed the 40% threshold for the first time in the 17 quarters. So what happened last quarter? They have brought up about 31 new data centers, and this brings the total of 88 data centers this year, which are up by 22% by count, which was 400 data centers by the end of 2025. So add up, you would have about roughly less than 500 data centers. So this particular acceleration, which was better than expectation, was because of the first reason is efficiency gain. So they build their in-house infrastructure, silicon AI models, which, for example, Microsoft AI model, what they call MAI, and also the Maya 200, which is their own in-house AI chip accelerator, design them together to deliver better performance and at a lower cost. So at 40% better performance at a lower cost. Now you can give out a lot more capacity because it's cheaper for them. Second reason is because of the early delivery of the additional cloud capacity. Now to bring up these data centers, bring out these equipment and so on is quite faster. To them, what they mentioned is that it's now easier to plug in and then faster to adopt the lift times. And the last reason is because of the stronger consumption from the coding services, which is GitHub Copilot. So what happened in the recent quarter, Microsoft has transitioned from per seat to now per seat plus consumption billing as much as as many as what the software companies is doing right now. And Microsoft is doing it recently. So additional usage of these Copilot GitHub coding services lead to additional billing consumption gain and sales, which leads to overall acceleration in the ICU. Moving on to the next point is the productivity. Productivity now is focusing on the higher value SKU, which is the premium product. Previously, the growth in the ARPU, which is average revenue per user, was driven by the selling in the frontline workers. But now the expansion is now also focusing on the premium products, such as the Copilot E5 and the E7, which is the subscription product for the enterprises. So what happened, this is a new product which was released back in May, announcement if you notice. They bundle together a product like Copilot, which was sold separately before. If you want to go use more options, then you have to pay more, right, for Copilot. They also bundle together AI agents and then AI governance tools, and these have become quite an attractive for the enterprises, and we see some increase in sales. And then if you look at it, the paid Copilot seats has now surpassed 30 million compared to 20 million in in the previous quarter, and then it's a strong number. And then the penetration is still only, however, at 6% compared to the total paid commercial base. That leaves us, in overview, significant room for them to further increase their adoption. Better outlook for the productivity of software estate. For the negative, we are seeing soft personal computing. The revenue for the sector declined by 4% on yearly basis. It is the second decline, and the third quarter, the margin fell. The main drag was the Windows and the devices subsegment of the soft personal computing. So it was because of the weaker PC demand and also because of the tough comparisons against the prior year, which the prior year benefited from the spike in sales momentarily because there's end of the support cycle for Windows 10, so people were buying. So if you compare, it's a bit of drag compared to the previous year. But still, the decline in 4% is actually better than expected. Because what happened because of the increase in the component prices, such as memory, the manufacturers and distributors were stocking up their inventory ahead of the component prices in June. So what happened? The inventory was better than what the sales was better than they expected. But moving forward in the next quarter, they expect plunge in the sales for this particular subsegment, low 20s, because now you got these elevated inventories at the manufacturers and the distributor side. So, and then coupled with the higher product prices that has already pricing into the market, this would weak on the demand and the weaker sales for this segment overall. And then for the outlook, we focus, because they roll over to the new year, right? We focused 17.2% growth, which is in line flat year-over-year sales since last year. We expect ASIO to continue accelerate to 45% next quarter, driven by the OpenAI backlog, which would materialize more meaningfully this quarter, and then strong enterprises AI adoption, and then they aggressively expanding. Demand, the good news is the demand is still continue to outpace supply, the same thing over the last 3 to 4 years. And then for the productivity growth, would continue to accelerate by this year, supported by the greater monetization of the premium products such as Copilot, E5, E7 that we mentioned earlier. The PC hardware segment would continue to be the drag and perform this next quarter as well, due to the higher pricing and then elevated inventory. The good news is that there wasn't any increase in capex this quarter. The capex for the remaining calendar year 2026 remain unchanged, but it's going to increase for the next year, which is quite normal. For the view, so we maintain our accumulated recommendation at a higher target price because better than expected sales and earning, and as well as lower than expected capex in last year. So that brought our TP higher when we roll over. Our focus for the 2027 remain unchanged. So we still like Microsoft because we still see strong long-term earnings visibility. They got this RPO backlog, which is 678, which is 2 times than their current sales. One way to look at this is that if you look at the chart right on the left side, you see this capex to the Microsoft Cloud revenue, and then Microsoft Cloud revenue goes beyond just Azure. It includes product in the other business as well, productivity, and as well as the personal computing, which any of these products are delivered in the cloud form. Those are Microsoft Cloud revenue. So the way we look at this to justify the capex spending is that as long as that number that you are getting back cloud revenue higher than the capex you spend in that particular quarter, that is good for us. Which, if you look at the chart historically, it has always been that same way. Still continue to deliver growth if they keep that pattern. We believe the investment capex that they spend is comparable to the revenue that they generate, or even if so, actually more than that. So that is all for me. Hand over to Serena for Meta presentation.
And thank you, Fahmi. Good morning, everyone. I'll present Meta second quarter 26 result. So the second quarter adjusted PATMI grew 2.8% year-on-year to $18.9 billion, while the revenue increased 28% year-on-year to $59.4 billion. This is driven by a strong user engagement and also ad performance. The revenue PATMI were at 44% and 41% of our financial year 26 forecast. Is below expectation, but do in mind that because the ad business is subject to seasonality. So starting from with the positive, we still see ad business to deliver a pretty strong result because, like I mentioned, revenue increased at 27% year-on-year to 59.4 billion. This is accelerating from 21% growth in the second quarter same period last year. So it was driven by both a higher ad volume and also improved pricing. So the ad impression actually grew 14% year-on-year because Meta continued to optimize their ad inventory. And secondly, average price per ad increased 12% year-on-year because of the improved advertising performance. They are higher and also stronger advertiser demand. And the company also continue to see an AI to continue to enhance the engagement because on Instagram, the global time spent now has been doubled. And for video watch time, which is one of the growing segment on Facebook, is growing at 9% year-on-year. This is for the user side. As for the advertiser side, the adoption of the AI-powered advertising tool has been quite strong because for Advantage Plus is now reaching over 75 billion annual run rate. But moving to the negative, which is another business segment, which is Reality Lab, it continued to remain unprofitable, and the operating losses actually expanded 2% year-on-year to 4.6 billion, even though the segment revenue increased 16% year-on-year. This is because they are seeing a very strong demand and growth in AI glasses, but it was partially offset by a lower Quest headset sales. But most importantly, moving to the second negative, which is there is a higher AI investment continue to pressure on cash flow. In this quarter, we see the free cash flow decline 91% year-on-year to $784 million, even though there is a 25% year-on-year increase in operating cash flow. But because CapEx increased 88% in this quarter, mainly for data center servers and also network infrastructure, that's why we see the significant drop in free cash flow. At the same time, costs also put pressure on operational profitability. So excluding the one-off $2.4 billion legal and $1.2 billion severance charges, adjusted operating income growth slowed significantly to 9% year-on-year. This is compared to 38% growth in the second quarter last year. And at the same time, operating margin also contracted over 6% and is now at 36.8%. And the reason that of this result is because of the higher operating expenses increased 46% year-on-year. Is because of the AI talent compensation, also infrastructure costs, including depreciation costs and also third-party cloud spend. And at the same time, there is also an increase on third-party AI token expenses, resulting in weaker result in operating income. Moving forward, when it comes to guidance, Meta guided a softer third quarter revenue of $61 billion to $64 billion, implies a growth rate between 19% to 25%. And this is softer because compared to same quarter last year, it was growing 26% year-on-year. And at the same time, the company also raised the lower end of the expense outlook to $165 billion to $169 billion. And they also narrowed the CapEx guidance, the lower end side, to $130 billion to $145 billion. So for both expenses and CapEx, they didn't really raise the guidance. They just narrowed down the range. As for the view, other revenue, according to Meta, this business segment exceeded $1 billion in revenue for the first time. It's supported by growth in WhatsApp business, pay messaging, and also subscription. Therefore, moving forward beyond advertising, we continue to see promising long-term AI monetization opportunity. This is particular in 3 segments. The first one is business agents, and the second one is APIs, and the third one is that potentially there will be an enterprise compute services. With monetization aspect, for example, for business agent, the monetization is expected to expand through usage-based token pricing. So we also believe Meta, since they have a massive user base, they should provide a strong foundation in order to scale AI services. But in the earning calls, in the longer term, we also see Meta have a preference to monetize intelligence products. So we believe that at the moment, we believe that it's logical strategically on the long-term basis, and we think that it could create a long-term recurring revenue. And also, if by strengthening the customer relationship, they can form a better pricing power in the long term as well. But on the short-term basis, the company mentions that they are receiving offer to rent or to lease or sell their compute capacity at a premium pricing. So in the near term, we do believe that by doing so, it could improve the return visibility and also provide additional margin upside, considering the company has spent so much on the infrastructure build up. But even though with all the positive view, we also continue to be a little bit cautious about and also continue to monitor the development of MuleSpark model family, because we continue to see LLM competition to intensify. And if you look at other competitors, they are working very hard to improve model performance and also trying to expand their AI ecosystem as well. But for Meta, we maintain our buy rating, but we reduce our this year target price to $750 from $795. This is because we lower our financial year 26 revenue and PATMI forecast by 2% and 5% respectively, because we do expect to continue to see a persistent higher operating expenses, and also because of the management softer revenue guidance in the third quarter, like I mentioned it before. Yep. And that's all from me. I will pass the time to Helena from Amazon and Apple. Thanks very much.
Thank you, Serena. I'll move on to share about Amazon, who released their earnings last Friday morning. Next slide, please. So for Amazon, both their revenue and adjusted PATMI outperformed, but it was primarily because this year the Prime Day is shifting from its usual third quarter timing to second quarter, so that kind of pulls forward the retail sales, and also because they have very strong AWS growth. So first half revenue and adjusted PATMI were 48% and 45% of our forecast. And we should know that because Amazon is an e-commerce company, so there is seasonality in their revenue. So moving on to the positive, AWS accelerated the 5th quarter in a row. It's the fastest growth in 18th quarter. We continue to see very strong momentum across both its AI and its core cloud workload. And what we like about AWS is that their bedrock continues to differentiate itself through its very vendor neutral approach and broad model selection. So it's kind of positioning itself as the most model agnostic platform among all the hyperscalers. Its in-house silicons also continue to gain traction. They've actually advised their capex expenditure to $220 billion from the previous $200 billion. They say it's primarily reflecting just higher memory cost. So that's going to reflect 67% year-on-year capex growth. And compared to their revenue growth, which we estimated to be 15% this year, it's largely outpaced the revenue growth. But we still remain very constructive for 2 reasons. The first is because we're seeing very, very strong demand visibility. Their backlog surged 154% year-on-year. And most of the AI capacity contract they sign is more than 5 years terms. And management already saying they expect the capacity constraint to persist through 2027 into 2028. And second, because AI infrastructure investment, they have a very compelling return profile. So if you think about it, the data center that they're building right now, once it was built, it has 30 plus years of useful life. So that allows multiple generations of servers upgrade without needing to invest in the data center again. While the servers and the networking equipment, they typically break even in less than 3 years. So I believe these factors added together, they should enable revenue growth to eventually outpace capex and supporting higher long-term ROI. On the retail side, they continue to deepen customer engagement through faster delivery and expanding everyday essential offering. So the same day and overnight delivery grew 40% year on year in the first half of the year, while its grocery segment continued to gain traction. Its most monthly active perishable customer rise over 50% this year, and the same day orders containing perishables, they usually average more than 3 times the units of products per order. So these initiatives, they're not just pushing the sales right now, they're also reshaping customer purchasing behavior. They're trying to convert those who traditionally spend offline into online purchases. And that is very powerful because once shopping habit changes and you become more increasingly embedded within Amazon's ecosystem, you're more likely to purchase more frequently and across a broader range of categories. So that is going to support long-term growth in their advertising and Prime monetization. When it comes to guidance, they've guided 9 to 12% year-on-year growth. That is slightly softer, but primarily because the timing shift of the Prime Day from the third quarter to the second quarter, and also they have some FX headwind. They've revised their CapEx upwards to 220, like I mentioned just now. We believe right now their AI strategy has becoming increasingly differentiated than its peers. So rather than competing to build the best frontier model, they're trying to position AWS as the vendor neutral approach. So that reduced the risk of them backing the wrong model in this AI war. And at the same time, they're trying to monetize AI across the entire stack, from their cloud infrastructure to Bedrock and to its chips. So this enables them to capture a greater share of the enterprise AI spending. And also it helps reduce their reliance on third-party silicons, particularly the NVIDIA GPUs. When it comes, we maintain our accumulated recommendation. We do raise our target price to $230. It is because we increase our revenue and PAMI by 2% and 5% respectively to account for the faster than expected growth of AWS. So that is all for Amazon. I'll move on to Apple. So for Apple, next slide, please. Both their revenue and PAMI are within our expectation. Revenue grew 17% year on year, which is driven by iPhone and MacBook, which grew 22 and 29% year on year. So the strong demand continues, supported by the robust iPhone 17 upgrade cycle, and also by the MacBook Neo's attractive pricing, which is driving a lot of adoption among the new users. Both products right now are experiencing supply constraint for advanced node chips. They've also rolled out an upgrade program which supports a shorter replacement cycle. So this program, it lowers the barrier to adopt to the latest Apple device with a flexible leasing model. So instead of purchasing, you're thinking of the usage of iPhone as a leasing. So right now the market price for the iPhone 17 is $799. But if you just want to lease it with this program, you only have to pay $23 per month and you can get a phone right away. So we believe this program is innovative because it can shorten the replacement cycle and it can enhance the ecosystem stickiness and improve the visibility of future hardware demand. Because when the upfront cost is so cheap, it's a high chance that when a new iPhone come out, you would like to upgrade to the new iPhone. And can also soften the impact of potential iPhone price increase should the memory price inflation got worse. Moving on to the negatives, so of course we have to talk about the memory inflation. It has become a major margin headwind. They expect the memory price to continue to increase in the next quarter and beyond. Apple mentioned they're trying to partially offset the impact through a lower cost of their carrying in inventory and favorable product mix. And also they're trying to drive down a lower non-memory component cost. But these benefits are expected to diminish over time. And the memory market is only dominated by 3 major suppliers. So that gives Apple very little sourcing flexibility. And excluding the tariff refund that we have this quarter, the adjusted gross margin declined 120 BPS quarter on quarter. And the management said more than 100% of that decline is attributed to higher memory costs. They've also guided adjusted gross margin of 46 to 47%. So that suggests margin pressure will intensify further. Moving on to guidance, they've guided a revenue growth of 9 to 11% year on year. So that is considered a slowdown compared to the current quarter's growth. They say 250 BPS FX heavy, and also there's significantly tighter supply constraint for their iPhone and MacBook. They say the bottleneck stems from the limited availability of the advanced node semiconductor capacity, and the current demand continue to exceed their internal expectation. So they're caught red-handed. And they can't really increase it in the short term. So because of this near-term flexibility is very limited, they're unlikely to fully capitalize on the current demand. They've guided for iPhone growth for the next quarter to be mid-teens year-on-year, which is also a slowdown. So I think Apple right now, they're facing so many issues. The rising memory costs continue to pressure. And on the AI front, the regulatory hurdles also remain. They have secure regulatory approved to bring Apple Intelligence to China, but they haven't really confirmed a launch timeline. And meanwhile, Smart Siri is also unavailable in Europe because of regulatory constraint. And given that Europe and China together accounts for almost 44% of their total revenue, so the delay in these markets will continue to limit their near-term monetization for their Apple Intelligence. The only spotlight they have right now is probably the strong iPhone and MacBook demand, but then they're also facing supply constraints, so they can't even fully capture that rising demand. So yeah, overall, we're still very cautious on Apple. We maintain our current target price. We actually downgrade our recommendation from neutral to reduce due to share price movement. That's all from me. I'll pass my time to Iqbal.
Yeah, thanks. I'll be presenting on Lung Research. Philip on the call. Yeah, sorry for the things. Yeah, so in Lung Research, given very strong guidance from it. In the current quarter itself, there are year-on-year revenue growth of 30%. So they guided next quarter revenue growth to surge by 52% year-on-year, $8.1 billion, as can be seen on the chart on the right side. Yeah, so this is the strongest growth guided since 2021. And the demand is being driven by the huge DRAM equipment investments from the memory players, and also NAND investments as the industry converts to higher layer plus devices, higher layer devices, especially used in enterprise SSDs. Yeah, so our management also guided that the CapEx will be maintained at 4 to 5% of revenue. So if revenue continues to surge, we think that CapEx will surge as well, because they are trying to ramp up their Malaysia facility, which is their largest, one of their largest facilities, and it will come online probably next year. And we do think that this will benefit Singapore component manufacturer UMS, which supplies to Lung Research. And looking forward in 2027, we are seeing more greenfield projects coming from the memory players. For example, Samsung has the Taylor Fab coming up. SK Hynix has the Yongqing complex and the M15X Fab coming up. Micron has the Tongluo Fab in Taiwan, and I think one more high bandwidth memory facility coming up either 2027 or 2028. So because these greenfield projects will require equipment to be loaded into it in order to produce the memory chips. We think that the pull-in will come in soon, either second half this year or the first half of next year. And this will benefit the equipment players, for example, Lung Research in this case. So that's our Philip on the go. We don't cover Lung Research. It's just the insights from the so from the end,
Yeah, thanks. Let me run through FCT's operational update. So in third quarter, FCT is a business update. They didn't give any financials. Yeah, so they made many transactions, or rather not many. They are doing a portfolio constitution. So they divested White Sands. So that's White Sands is their small. So they divested that for about 467 million. So they did that at a premium to valuation, 4.6% exit yield. But it's at a 1.9% DPU dilution. Yeah, but despite this DPU dilution in the near term, we think this deal is attractive. This divesting White Sands is attractive, given the fact that there's a new strong competition in the region, which is Pasir Ris Mall, which opened in 2024. So long term, the growth prospects at White Sands might not be that strong with this new Pasir Ris Mall coming in. And in a separate transaction, FCT will invest and hold a 50% stake in the retail component. So this is in the Bayshore Drive Integrated Development site. So this is together with the sponsor. So they will own the retail component and it comprises about 170,000 square foot of retail NLA. So FCT's portion will cost about 300 million. So we are looking at about 5% yield on cost on a stabilized basis. So this will start contributing once it's completed, so likely end 2030. So once it's completed and on a stabilized basis, we think this could increase DI or DPU by about 3% upon this stabilization. Yeah, so other than these transactions, for the operations wise, it was healthy this quarter. So occupancy, it declined slightly, so 99.8 to 99.6%. That's mainly due to tenant churn as they try to focus on tenant mix and enhancing the tenant mix. So now during this quarter, they welcome 69 new to portfolio tenants. So it is really a tenant refresh. And our financial position also remains stable with a lower cost of debt. So 3% for this year and 66% hedge. So their leverage also, it will decline to about 36% once the White Sands Mall is divested. Yeah, and they do not have any debt due this year. Next year, only 4%. Yeah, so for the outlook for right now, they are going through two AIs, Hougang Mall and Next. So for AI, Hougang Mall is 98% pre-committed already, expected to complete within the next 2 months for the full Hougang Mall AI. So 40% of these new tenants are new to mall tenants. So it's really a tenant refresh. Similar to the AI and Next also, 87% pre-committed and 73% new to mall concepts. So this phase one at AI and Next is scheduled for end 2026 completion. The phase 2 will be the one where they unlock the GFA from the car park. So that will be a bigger AI. And they're also in early stages of the AI, of the planning for the AI for Causeway Point to capitalize on the RTS possible demand from JB. Yeah, and for rental reversions, we're expecting a 5% rental reversion, 45% rental reversion for this year. We think this is a conservative number. Likely the full year will end up towards a high single digit, towards like 6-7% rental reversion. And this is supported by the favorable supply conditions. So suburban retail is only accounting for less than 26% of the new retail supply. So, and on top of that, the new retail supply is also only about 1% over the next few years. So really limited demand and limited supply with still very strong demand, especially from overseas retailers, F&B. Yeah. And with that, so we maintain our buy call. FCT is paying a dividend yield of 5.5%. Yeah, next slide, please. Yeah, so moving on to CLAS. Over the past few quarters, they've been transforming the portfolio for growth. So there are really quite a few transactions. But for FY first half 2026 results, it was exactly in line with expectations because they've already guided a 6.1% full year DPU. So as a result, the first half is also same as last year. They did retain some of distribution from non-periodic items in the first half of about 9.6 million. However, the core distribution for first half, it declined about 10%. That's mainly due to assets undergoing AEI and FX and some one-off adjustments as well. Yeah, if you look at revenue, the Cavendish London closed, also something wrong with my camera, but I'll continue. The Cavendish London, it closed for renovations and the absence of contributions from the divested properties were offset by some acquisitions and also from timing issue from divestments and redeploying the capital. Yeah, same store basis, the gross profit, it declined 5% due to one-off adjustments like I mentioned as well. And yeah, so looking at the operations wise, the positives, the borrowing costs remain very low. So only 2.8%, 77% of their debt hedge, and their gearing is also improved to 37.7%. And on top of that, their portfolio reconstitution is taking shape. So in the first quarter, they acquired 3 rental housing properties in Tokyo. So this is their strategy to to increase the living sector to about 25 to 30% of their portfolio. So this is a stable income base. And also they completed the divestment of the Robertson House by the CLAS collection. So this was at a good price, 2.3% as the yield, 4% premium to book. And currently 3 properties are undergoing AEI. So that includes the Cavendish London, which they've previously mentioned that they'll use previous divestment gains or retained earnings to top up the income loss for the Cavendish London, because that is quite a big property. And also Somerset Clarke Quay Singapore is on track for 2026 year-end completion. So Somerset Clarke Quay Singapore is the previous Liang Court. So it will start contributing from 2027. Yeah. And for demand-wise, we expect Cluster 6 core markets, the demand to remain resilient, at least a flat RevPAR, portfolio RevPAR as well. RevPAR this quarter was down 2%, mainly because of assets undergoing AI, but on a like-for-like basis for the 6 core markets, it was up about 1%. Yeah, and to got a bit of the outlook, the US portfolio benefited from the World Cup, so we saw a 22% increase in RevPAR during this period, and their PBSA also rebounded strongly. So if you recall, in the past year, in the previous academic year, the occupancy was 88% because there was some increase in supply in some of the markets, and as a result, the rents also declined slightly, declined by about 1%. But in the next academic year, there was a strong rebound. So it starts in September, August, September. So it's already 95% pre-leased, and the rents are 5% higher year on year. So the PBSA is really rebounded. And CLAS will continue to execute on its capital recycling strategy. So basically deploying proceeds from divestments into yield accretive acquisitions like what they've been doing over the past few quarters. So this is really to enhance the portfolio returns over the longer term. So they are focusing on the living sector in their 6 core markets. So their 6 core markets is Singapore, US, UK, Japan, Australia, and Europe. Yeah, so for the Cavendish London, post AEI and Somerset Clarke Quay, so those, once they are completed, they're expected to contribute 0.16 cents to next year's DPU and increase to 0.21 cents and 0.5 cents in FY 2029. So that will be a pure uplift to the DPU in the coming years. Yeah, so given the guidance of a 6.1 cent dividend, that's a 6.7% dividend yield. Yeah, no change to our target price. Yeah, next slide, please. Yeah, so our first REIT, their strategic divestments received the green light. Yeah, so unit holders, they approved the divestment of the proposed hospital and non-core divestments. Yeah, so just looking at the first half results, gross revenue is down, DPU is down also. That's mainly purely from the fact of the depreciation of the Indonesian rupiah and the Japanese yen against the Singapore dollar. So both IDR and JPY declined almost 10% year on year. So that's really a huge decline which impacted the revenue and numbers. So it was also slightly impacted by the divestment of the IAHCC, the Imperial Araduta Hotel and Country Club. So if you on a like-for-like basis, it was down 6.6% if you exclude the divestment. Yeah, however, for First REIT, the positives remains that they are due to the base lease escalation, the lease structure, the operations in local currency terms remain very resilient. So from Indonesia, it's up 4.7%, but it's impacted by the FX, and Singapore up 2%. Japan was stable, but it was also impacted by the FX. Yeah, so for the negatives is that the rental arrears from MPU remain outstanding. Right now, about 7.7 million outstanding, but once the transaction completes, this First REIT will receive full recovery pending the completion of the divestments. Yeah, so like I mentioned earlier, the unit holders approved the proposed divestments of both the non-core and hospital assets. So remaining First REIT has 6 Indonesia hospitals that are remaining. So they still have a put option to divest the remaining 6 of these hospital assets to Siloam. So for almost 295 million. Yeah, so for this proposed divestment, because they are going to receive the amount for the hospitals in rupiah. So in early June, they hedged 95% of this hospital divestment consideration. So that's almost 5 trillion rupiah. So this is to mitigate the FX risk from converting the proceeds into SGD. Yeah, for the non-core assets, it's going to be paid in Sing dollar, so no need to hedge there. And for the rest of the 6 hospitals on the balance sheet that's remaining, they've hedged 45% of it to protect the NAV and gearing. So gearing, it rose to about 45.7% due to translation of the balance sheet. And once the first tranche of divestments, which is the hospital assets as well as the non-core assets, completes, so gearing is expected to decline to about 17% upon completion. And for now, the strategic review is ongoing. They did not give any updates on how the proceeds from this investment will be redeployed, other than the initial one to pay down debt. So no assets, or no portfolio basically they didn't give any info yet, on how the portfolio will look like once they exit Indonesia. Yeah, so we are waiting for more updates on that as they continue their strategic review. Yeah, so based on about 1.98 cents forward dividend that we are expecting for FY 2026, based on the fact that the proposed investment is not completed by this year, but very likely will be completed within two months. For the full year, we still forecast about 2 cents dividend. But once this, assuming that these divestments of the hospital and the non-core assets completes in September, then the dividend DPU will decline from 2 cents to about 1.5 cents for FY 2026. Yeah, so right now our TP is based on 23 cents. So 23 cents is 1 times price to NAV of the NAV per share of the REIT. Yeah, the NAV per share of first REIT in first half is 23 cents. Yeah, so then accumulate call. Yeah, so next slide, please. Yeah, I'll run through maybe MPAC's affiliate on the ground. So for MPAC, their first quarter DPU is down 2.5%. So that's mainly from lower overseas contributions as well as divestments. So it's partially mitigated by very strong performance in Singapore, especially in VivoCity, and lower finance expenses. So just looking at the operations wise, on the right hand side, on the top, you have the occupancy rate, and at the bottom you have the rental reversion rate. Yeah, so for the occupancy rate, it declined quarter on quarter. So as of March 2026, it was 89.4%. So now it declined 5 percentage points. So that's quite a huge drop to 84.4% occupancy. But that's mainly from the non-lease renewal of Fujitsu building under Japan. So that you see in the red box, that is the huge decline in occupancy from 75% to 56%. Yeah, so for the Japan properties, that's mainly because the Makuhari region also, the leasing demand is really, really weak. So we do expect occupancy to remain weak there for Japan. And looking at MBC, so the first line on top, the occupancy declined slightly. That's mainly due to tenant downsizing. However, it's expected to pick up over the next few quarters as they've signed some leases that are expected to commence over the next few quarters, and as a result, it's likely that the occupancy at 94.3% is the lowest this financial year already. Bear in mind, this is the first quarter results for MPAC. Yeah, and for Festival Walk, you see the reversions are negative 9%, 9.1%. That's despite tenant sales improving 4%. So tenant sales in China generally has been increasing across the board, we noted. But that does not really translate into positive rent reversion. So we are still seeing a negative like 10%. So we expect this to continue as well. For China, so the performance remains quite weak. So we see China properties, the rent reversion almost down negative 30%. So it's down negative 29.2%. So that's mainly because the market rents are still below the passing rents in their existing properties by about 20-30%. So basically, over the next 3 quarters, we are still expecting the China properties to see a rental reversion of negative 20-30%. But at least the positive, at least they are trying to fill their properties at a lower rate rather than leave it vacant. So that will be worse. And yeah, the standout performer is really VivoCity for their portfolio. So shopper traffic up 5%, tenant sales up 5%, and a very strong occupancy, so almost 200%. Yeah, so that's as for MPAC. Hand over time to Hashim. Thanks.
Thanks, Darren. Yeah, next I'll go through Singapore Airlines 1H27 results update. So for Singapore Airlines, their revenue slightly exceeded our expectations. Their revenue increased close to 20% year on year. And there is two reasons for this. One is their passenger segment. Their passenger segment grew in terms of both volume as well as pricing. So volume was up about 6%, pricing or yields were up about 12%. The second reason is their cargo. Cargo was up about 33.5%. So this is a huge surge in their cargo revenue. But the main reason for that is because Middle Eastern carriers cut their capacity in terms of flights. So Singapore Airlines was able to benefit from that because they had transit flights from Singapore going to Middle East, and they were able to capture this cargo volume. But going forward, with Middle Eastern carrier capacity coming back, we do expect some weakness in terms of yields, and we might not see the same performance in terms of rerouted capacity through Singapore. Balance sheet wise, they are on a small net debt balance of 264 million. But more importantly, they have close to $3 billion in undrawn credit lines. And we think this is a huge plus for SIA because there are a lot of airlines which are all going through this fuel price volatility and cost pressures. But those that will be able to deal with it is first those that have good hedging programs in place, which SIA has, and second, those that have this cash capacity to deal with the unforeseen risk. And SIA has that capacity. They have credit lines, and that's what differentiates them from other carriers. The only two other carriers that have such financial capacity is ANA Holdings and Ryanair. Negatives wise, despite the hedging, there is some rise in fuel costs. So net fuel costs, which takes into account your hedging, jumped about 80% year on year. And currently, fuel makes up about 40% of total group expenditure. Previously, it made up about 28%. But they do have hedging programs in place, and they are currently also putting together hedging. They typically report their hedging policy every half yearly, so we can expect an update next quarter from them. Another negative is their associate losses. So non-operating income included interest, taxes, but also Air India losses. So they lumped it all together in one, and that increased about 45.3%. And they explicitly stated that Air India losses were about 42 million higher year on year. We went to check Air India's FY25-26 results. It's currently running at a loss close to 3 billion. It has negative net assets and it has negative operating cash flow. So we do expect that they might need external financing from their sponsors. And what we heard from SIA is that it does not have to be equity injection. It could be structured in a different way, which we think could be a debt or shareholder loan. Outlook wise, their main company specific risk is their SIA associate loss. SIA is facing multiple headwinds. First is the Pakistan airspace closure, which is still ongoing. There is elevated fuel prices as well as a FX headwind because the rupee is depreciating, and that's weighing on Air India. But there is some relief that the Indian government had put out. First is $1.4 billion jet fuel price stabilization fund. So this is one where they are providing fixed jet fuel pricing due to all the volatility going on. And the second, airlines in India, they are taxed on both the company level but also on the jet fuel level. So there's value added tax. And in certain states, they're cutting the value added tax from 20+% to close to 7%. So that would also provide some relief in terms of fuel cost pressures for Air India, which directly affects SIA. So we have a neutral on them with a higher TP of 735. We increased the price to book multiple from 1.1 to 1.4x. So with that, I'll pass on to Yi.
Thanks, Hashim. Hi, good morning, everyone. I will be presenting on the July FOMC meeting. Next slide, please. So the outcome was in line with expectations, with the Fed keeping rate unchanged at 3.5% to 3.75%. So there are three key takeaways from the meeting. First, one reason that the Fed keep rate unchanged was that they think higher treasury yield had already tightened financial condition. So Walsh noted that yield had risen quite significantly since the previous meeting, with 2, 5, and 10-year yields up by 25 to 28 basis points. So from the Fed perspective, financial conditions have already tightened, which give them more time to assess the incoming data before deciding another rate hike is needed. That said, the Fed remains very focused on 2% target inflation target. So Walsh mentioned that after more than 5 years of above target inflations, 1 or 2 softer inflations reading are not enough. So they want to see more convincing evidence that inflation is on track to return to its target level before considering any change to its policy stance. So the third message is on AI. The Fed acknowledged that AI investment is supporting business investment and manufacturing activities. But at this stage, they believe it's still too early to know whether AI can lift productivity enough to support stronger growth without adding to inflations. So looking forward, our base case remains that Fed will stay on hold for the rest of the year. So if you look at the latest data, we think they still support that view. So on inflations, we haven't seen a renewed accelerations in underlying price pressures. So we can see core PCE moderated to 3.4% in the second quarter from 4.4% in first quarter of 2026, where June core PCE was unchanged. And at the same time, labor market conditions remain broadly stable. And if you look at the demand, we can say it's still holding up. So we can see real finance sales to private domestic purchases has accelerated to 3.9% from 1.7% in the previous quarter. So overall, we can say the demand is still resilient, but it hasn't fit through into a broader inflation pressures. So I think this should support our view that Fed will remain on hold through year end. So that's all from me. I will hand it over to Zin. Thanks.
Thanks, Zee. Good morning, everyone. I'll move on to the technicals. Next slide, please. So first one, the S&P 500. Last week we saw a rebound on a weekly basis of 1%. I think if you look at the chart, I think it's looking more positive as well, as price is recovered above the short-term 5 and 10 SMA levels, which are the red and blue line you see in the chart. So price was previously under that since 17 July, but has since recovered end of the week, with also a bearish exhaustion candle below the upper support line as well. So I think overall in near term, we are likely to see further upside ahead to retest the recent resistance at 7,577. So this is the resistance form since middle of June that's held as a resistance since then. So all in all, current resistance likely to be at the 7,525 to 7,605 area, and support we think likely to hold at the 7,435 to 7,480 area. So that's the support is recent around the 10 SMA level currently. Next slide. So next one on our ETF money report for July. So I think that Singapore equities are likely to outperform in August again. So to review the various asset classes performance in July, most of them were in the green. So the top gainers were the ETFs tracking oil as well as the Hang Seng Index, which was up about 15% each. So that's the XOP as well as the Hang Seng ETF 2828. In terms of the decliners, there's only one, which was US Treasury bonds down 1.3%, and S&P 500 was flat. So in terms of the outlook for August, we think that Singapore equities are likely to continue the bullish momentum in the current uptrend. And we also is likely to see some slight rebound for the US Treasury bonds, as it's currently nearing the range support area. And for some of the various assets, such as the S&P 500, gold, and oil, we are likely to see some sideways consolidation continue. And on the other hand, for Bitcoin and Hang Seng Index, we think price action will likely be weak, with Bitcoin likely to resume its bearish trend and Hang Seng Index likely to pull back after a strong rebound in July. Next slide. Yeah, so next one, this is a chart on the Philadelphia Semicon Index. So we think that the price is likely to do a further rebound after a recent share price index correction of about 28%. So if you look at the chart, I think it was on Wednesday, price did form a very straight below the 10,900 swing low support level, and this is also below the purple line you see in the chart, which is the 100 SMA level, coupled with the RSI indicator near oversold about close to 30. So price did do a very sharp recover above there on Thursday. So if you look at it, it's quite similar in terms of the price action that we've seen at the end of March, where there was also a very brief breakdown below this key support level and price recover afterwards. So I think we are positive on the Semicon Index to do a further rebound. I think in the short term after the recent correction to retest the next key resistance will likely be the 12,500 swing high level. Yeah, so for now the first resistance will be 12,000. That's the 20 SMA level on the daily time frame. And then next one is 12,500, which is the swing high level. And then I think the support will be around 11,100 to about 11,300, which is currently about the 5 SMA level, and also which is the 5 SMA level currently. I think that's likely to hold. Next slide. Yeah, so next one, this is a chart of the software sector ETF IGV. So I think for the software sector, there's also some positive signs as well, as price remains holding support along this upper support line in black, since this was formed since start of April. And last week, price recovered above this $90.30 level after retesting at the start of the week, and then we can see price action overall last week was bullish as well. So I think with that, we are likely to see this bullish momentum continue and further upside to retest on the higher resistance levels near term, which are likely at $99 and $103 next. Yeah, and yeah, also currently price is also holding above the short-term moving averages. So I think this positive overall for the semicons as well as the software in terms of the charts, where I think we could see a rebound in both sectors, where previously there was a negative correlation among these two sectors. Yeah. So that's all for me for the technicals. I have time to call. Thanks.
Yeah, thanks, Zane. Sorry. Let me move on to Sheng Siong's results now. So Sheng Siong released their second quarter results last week. For us, I mean, they are performing well, but we just find that the stock might be pricey for now, as per the title. So anyway, the results was within our expectations. I think for the PATMI was 48% of forecast. The earnings actually rose 11%. So what drove it was their gross margins, record gross margins, which is probably now the 14th consecutive year of continuous increase in the gross margins. So it's a bit of broken record. But the other thing, the main driver for growth has been the increase in store footprint. So you can see that if you look at the chart on the left, you can see that the store footprint is up around 10%. So that supports the new stores supporting revenue about 11%. So most of the growth, as usual, comes from increase in stores. They also raised the dividends 17% year on year. The positives for us is, of course, the continuous rise in gross margins. So why is it rising? It's mainly because higher contribution from fresh. So when I say fresh, I'm talking about meat, chicken, vegetable, anything that requires refrigeration. That's the definition. But the one category that's doing exceptionally well for them is actually frozen, ready-to-eat meals. Especially protein meals, which I guess all the youngsters like to eat these days. The other thing is, of course, new stores. So new stores, like we mentioned, is up. The footprint is up 10%, so that will push revenue. There wasn't much in terms of negatives. In terms of our view, we actually maintain earnings, but we actually downgraded from accumulate to neutral. So we've already putting on very aggressive valuations. So we raised it to 331. So we are putting like 28 times PE, and this is the peak valuations that they enjoyed during the pandemic. And as you know, pandemic was when there was a lot of pantry loading, hoarding of groceries and so forth. And at that time, valuations was 28. So we're even putting it 28 times and rolling it to FY27. So that's why we're really putting very aggressive valuations, and even that also the upside doesn't look much from the current point of. So we just say we downgrade it to neutral. In terms of the new stores, there should be we estimate maybe 5% of new store growth, so it will be slower than last year. The reason is that they're closing 3 stores, although they're adding maybe 6 stores or more, but they are closing 3 stores, so that will kind of negate the growth in new stores. The second thing is that operating costs we think will rise again in second half. So electricity is negotiated every year or 1 or 2 years. So there's another large negotiation coming up in the second half. I think September, October. So that could actually push up costs again. So that is another thing that could hurt earnings in the second half. And there is one, I think nothing new. There's a big major capex that they're going to do, almost 500,000,000. So because of the growth in the company, they need a larger kind of distribution center come warehouse logistics. That will only already broke ground. So that will start to drain cash from next year onwards. The impact on earnings, not so much yet because depreciation only starts in 2029. But that in a very short term will be also a negative because it's going to have a drain on cash and so forth. Next slide. We move on to Raffles Medical. So it's being squeezed by lower price alternatives, which I'll explain later. So we maintain our neutral. So the results was below expectations. So the first half was about 40% of our full year. And earnings, if you remove some of the one-offs, actually came down almost 18%. So why is it so bad? So because this thing called the transitional care facility, and so I just to dial back in case some do not know. So when the pandemic happened, there was too many patients, and that's why the authorities had this transitional, call it like temporary hospitals, but they're not full-fledged hospitals. But I think Raffles few years ago bid it again for this TCFs. This was in Changi, and another one I just slipped my mind. But because of that, right now, because of the higher number of public hospital bids, there's less need to use the TCF, and they will get hit. Because all this TCF, you got fixed costs, you got the rental payment, you got staff and all that. So that was the one that put down earnings. The positives is the resilient hospital services, basically higher patient, you call it revenue intensity, basically more intensive cases or higher pricing in a way. So that helped the business. The negative, like we mentioned, is the TCF. So we lower our earnings, we lower our target price, and we maintain our neutral. So we still think the second last bullet point, we still think it's going to be a challenging environment. I think patient volumes in general are not unique to them. For most of the private healthcare is under pressure because foreign patients, most are going to Malaysia as a cheaper alternative. And right now, the new thing that's happening is that, of course, public hospitals have ramped up the capacity. So that's also hurting patient flow. And the third thing is private insurance companies also are starting to put pressure on some of these, the way private hospitals are charging. So all these are putting on pressure points for them. My last point is, of course, the big growth driver for them will be China operations is growing, but I think regulatory changes is always going to be a perennial unknown because the thought process here is that public hospitals need to co-share the cost. So I'm not sure how much the Chinese authorities is going to allow private hospitals to do too well. I mean, just my own view. Finally, there was one question on whether there can be a special dividend because it's their 50th anniversary, which I didn't know it myself, but they do have a capacity to pay special dividend. So just to give you some numbers, Raffles generate maybe 100 million of cash a year. They pay out maybe 50 million for dividends. So there's another 50. Most of the capex has peaked. They were spending almost 50 million a year in China, but right now their capex is only 10. So they got more than enough leeway to pay a special. And their net cash is about almost 200 to 300 million. So there is a capacity, but for us, we cannot forecast these things. But we can only say that there is capacity for them to pay special dividend because there was a question on it earlier. Next slide. So I'll move on to Keppel. So for Keppel, we are expecting a stronger second half approaching or coming. Next slide. So earnings were generally in line. The underlying earnings, you strip off the valuations and all the one-offs, right? So we think the earnings grew about 16%. Mainly for one reason, because they have a new power plant, and that power plant is going to push capacity by 45%. So in terms of the earnings, there was a jump in earnings. If you look on the left, I forgot to put those red bars, but anyway, if you look at the bottom part, the infrastructure, that grew about 11%. So that's because of Keppel Sakra, the new power plant that came on in May, and DSS. So DSS means, like, you can just think of very easily, just think of operation and maintenance earnings. Because they're competing some waste to energy, which they're actually like a world leader. The second positive is that, again, just to double a bit of history. So after the restructuring with Seatrium, there were 16 legacy rigs, they call it, stuck in Keppel's balance sheet. These are assets that they want to monetize. It's about 4 billion. So of the 13, they managed to monetize 6, or push the 6 into a fund. And with that, they monetize, and the another 4 are being repaired, or upgraded to it to be in operating conditions. So that's a positive, because any monetization that they do, Keppel will pay 10 to 15% of it as special dividends. The negative is, again, on monetization, is real estate. You can't see the numbers on the left, but they monetize less in real estate because they still got a lot of real estate in China. So last year they monetized 800 million, this year about 400. So 50% drop, and because China's real estate in China is actually performing very poorly. I mean, in general, for everyone. So we maintain our target price, we maintain our earnings. So what to look out for in second half is, of course, you get the full year 6 months contribution of the new power plant, which has already been fully contracted out. And then you get a jump in fund under management, because what happened is, in July they got this really big spike in assets. So they got 13.5 billion that was secured as new funds. So all this will start to contribute as asset management because these are committed. So once you commit, you have to pay money. It's not based on funds deployed. So that will start in the second half, and then O&M will gradually rise because they completed the waste to energy, and also the submarine cables, the 5 pairs of Bifrost. Sorry, there's a typo. There should be massive order book. The next is special dividends. They should realize at least 117 million of special dividends of about 6 cents. Next slide. So I'll move on to our usual macro update. Next slide. I'll try to do this faster. So in general, manufacturing in Singapore is still performing really well, about 18% electronics. For banks, the environment continues to be very positive. I think loans continue to accelerate to almost 9%, which is unheard of. I think 2-3 years ago, loans growth in Singapore was like -1, -2. So now it's 9. Deposits also accelerating, especially after the Middle East war. You saw this big spike in deposits, and of course, there's some Hong Kong regulatory impact too. RevPAR is still stable, and then employment. I won't run through all this, but and in the US, of course, the big news, like what probably Z mentioned, is also the inflation numbers. So our general view is that we, like what Z mentioned, we do not expect a rate hike, because we do see inflation decelerating, and it's a volatile number because it depends whether the Middle East war is on or off. And we think it's politically untenable to raise rates, because you're coming to the midterms in the US in November, and that's why he can't have a war and have higher fuel oil prices, unless you want to lose the midterms. Yeah, next slide. So in terms of tactical views, there was another record. We have some of the charts later on July performance, but it was another record performance for the STI. It was another new record last week. The banks performed very strongly. Banks are up 13% for July, I think the market is banking on stronger than expected earnings in the second quarter, and there is momentum in loans, deposits, and of course capital markets with all the IPOs and all the trading activity. But we do find banks a bit rich at 2 times, and the yield has already come down to only about 4%. So we think it's better to rotate to the other large caps. I think like for Capital, we mentioned we think there'll be a stronger second half with the new power plant, asset management and maintenance. And then for Sembcorp, which has been sold down very aggressively because I think the market's expecting weaker first half results. That's because I think a lot of their counterparts in India that's reporting wind numbers have been very poor. So that's why you should expect soft renewable, which is actually supposed to be the fastest growing segment for them, but it will report weak results. But for us, no, this is weather related. So to downgrade this permanently, we thought it's a bit too tactical. So we still like it. And then, as you know, they made this 5 billion acquisition of the Australian Genco, and that will prop up earnings. So that's why we still like Sembcorp. For Singtel, they are making some asset monetization efforts, like a stake sale in Optus and also a listing of their data center in Hong Kong and hopefully even in Nasdaq. So we think probably after the bank results, it's probably time to rotate out into these other large caps. So in terms of a quick comment on small mid caps, so small mid caps, the next 50 only up 5% this year. OCBC up 43%. So I'm not sure. No need to go and analyze so much. I just go buy OCBC. So one of the reasons we think small mid cap has been weak is also the big sector has always been construction. But construction, I think the market's starting to worry that all the contracts we have probably have a peak in construction awards. So I think that's going to be the worry. The T5 awards haven't come in yet, so probably by year end you get the T5. But after that, like what someone has mentioned before, there is no T6. So as a result, I think that's causing a lot of concern for the market. But building materials have done well. I think Pan United is up almost 40% this year. Another one that did well last month was RX Biopharma because it was up almost 40% last month. So for us, our view is in terms of news flow, what we are waiting for is that we are waiting for the EUA, which is the Emergency Use Authorization. So what this means is that before the FDA give formal approval, on very rare occasions, they will actually give you an emergency use. So you don't have to go through the phase 1, phase 2. And then if that is approved, then you will get the orders from the US Department of Defense for military use. And just to recap now, the EUA is a very major event. If you exclude COVID, the only time the EUA was awarded was during a Zika virus, anthrax threat, H1N1. So to get that is a very major thing because it just shows, validates the technology and also it brings revenue because the army is going to order it anyway. So in terms of some of the, sorry, the typo here is not 73 August. In terms of some of the events to watch, all the two banks should be announcing results. Of course, SpaceX too, which we actually just issued a report and we call it had a sell on it. Yeah, but just a glance on reservists you can't present today. And below is some of the webinars coming up is open to everyone. Some of the new ones like Justco. Yeah, if anyone wants to know more about this new IPO. Next slide. Okay, just to show you the chart on the left, just to show you the acceleration in banking loans, which is unheard of. Like I said, 2023 was negative, and then now it's like almost 9. So this is very good for the whole Singapore economy because it's like leveraging up. Of course, I'm talking good in terms of growth, I mean, not in terms of financial risk, but it's a positive for the whole economy. And also there's a jump in deposits. The number you see there was that June last year, the trailing deposit inflow was 108 billion. Now it's hit 150 billion. There was a big spike from March onwards when the Middle East war happened. So the liquidity is going to boost growth for Singapore too. Next slide. Okay, nothing much. This is our view here is that this is the US inflation number in red, but what we do see is some of the services things like wages and rent, they're all disinflating. So it's not a given bet that inflation is going to be like run rampant in the US. This is the futures market. Market still pricing in one rate hike probably in September, the plus 37, and then probably another, I don't know, market is undecided for 2027. I know it's too far away, but I know this is just a chart. And the green line just to show you the 2-year bond yields. So this is really what the market is expecting, which is also one rate cut. So the green line tends to lead the blue line if you notice. So the market seems to be, of course, it's super volatile anyway. Next slide. Okay, this is the most complicated chart again. We always show this whenever the MAS change the money. This is just to show how the MAS conducts monetary policy. So if you focus on the blue line, this is where the Singapore exchange rate, the rate on is US dollar, but just ignore that. So when there is when you see the blue part, usually the Sing dollar will be strengthened very strongly because that's when the MES gap up because they was recenter upwards. Now, of course, when you see the orange, which is very rare during the Asian financial crisis, where they want a weaker currency, then it will gap down. Most times, the default for MES is increased slightly. That's why you see all the white spaces here. And the green is also when the economy is weak, they have zero appreciation, like during the COVID. So that means they don't appreciate the exchange rate, which is actually a basket return, not against the US dollar. Against the US dollar, just zig up and down. It's like some random movement. Next slide. This one again, all this is not gonna, like I said, not gonna impact the stock market. But if you just want to understand what's going on, most times the MES will manage the slope. It's always maintain appreciation. Then now increase slightly. That means they want the Sing dollar to be stronger against the trading peers. Then once in a while they will gap it up because inflation was rising very sharply in 2022 because of the and then so this time around they are making the Sing dollar stronger because of stronger growth. Nothing to do with inflation, as you can notice. The last two rows on the far right didn't change. So just that they think that the firmer pace of growth for the US, for the Singapore economy. Okay, let me try to wrap this up. It's taking too long. Next slide. Okay, I need very quickly just the monthly performance in July, which we'll do every time. So this is the one on the left is just by sector. You'll notice the finance sector did very well. It's up about 13%. The one on the top, on the right, is all the top 10 gainers, small, mid cap, everything, and losers. So like all the semicon names were the big losers for last month, AAM, Franken, UMS. The bottom is the index gainers and losers. So OCBC is up about 17% last month alone, better than small mid cap. And the losers were Samcorp, Venture, and so forth. Yeah, next slide. So this is the performance by asset class in US dollar terms. So Singapore did well so far this year, up 21 compared to Nasdaq 6 and even S&P. Again, all this just for your reference. The worst performer was Nasdaq because of the tech sell down. Next slide. And this is by asset class. Hong Kong did very well. So Hong Kong did well mainly because of, I think Alibaba up almost 27% because of the CXMT, hope I'll get the acronym right, listing in China. Yeah, but the rest, Singapore is probably the third best performer, yeah, in Asia, ex-Japan. I mean, in Asia, sorry, local currency. Next slide. I think this is the last one. Sorry. This is our model portfolio. So we actually have the two banks. You notice year to date OCBC up 47. Sorry, not 43. But what pulled us down was Samcorp and also Franken because of the tech sell down. This is the performance on the right hand side, just for illustration. Okay, yeah, thanks. I think I can move on to Q&A. Yeah, thanks everyone.
Okay, I guess I'll start. So there's a question, what does the investment in Anthropic mean to Amazon in the long term? The primary reason that Amazon decided to invest in Anthropic is because they want to drive their own demand in AWS, because Anthropic right now, they trains and serves their cloud almost entirely on AWS using Amazon's training chips. So when Amazon pump in money into the company and help it grow, and as cloud usage grows, Anthropic will become one of their largest customer, and that is going to end up rewarding Amazon itself. So this is very similar to when Microsoft invested in OpenAI. So they're always thinking that in the end, it would just come back to reward themselves. And also another reason is Amazon, they're trying to putting a lot of effort into their in-house chips, the Trainium Graviton. And Anthropic now is they're essentially the flagship customer right now. So if cloud is able to successfully train and serve on their Trainium, instead of NVIDIA GPU, that sends a very effective message to the entire industry that, oh, if Anthropic can run one of the best model on Trainium, then so can you. So that is going to help them sell their in-house chip as well. Amazon right now is already the third largest chip makers in the world. And another thing is, like I mentioned earlier, unlike Microsoft, which is mostly revolve around OpenAI, and Google is focusing on Gemini, Amazon, they want their backlog to offer multiple leading models. So they definitely want to secure a cloud being on one of being one of the model that they offer. So that makes their backlog more attractive. And I guess also invest also it kind of give them a seat at the AI table, so which is very important for them right now. So yeah, I hope that answers your question. Will Apple upgrade program be a drag instead of upside since supply constraint or bottleneck will work against a shorter replacement cycle? I would say not really, because even when there's a bottleneck, I mean, it's always better when you have a bottleneck and you have so much overwhelming demand and you can't keep up with the supply. It's always better than having this, than you have so much supply sitting around and there's no demand. And right now, the supply constraint is there because Apple is themselves. They also didn't expect the iPhone 17 will work so well, so they didn't really pre-order so much of the component in the beginning, which is understandable because iPhone 17, if you really look at it, they don't really have that much Apple intelligence like AI upgrade. It's really just the hardware. We're also wondering like what is actual reason that iPhone 17 line has been doing so well. We think the likely reason is the latest surge that they have in iPhone was in 2021, so that is about 5 years. So now it's the AI race, and 5 years is the reasonable amount of time where your old phone start not working and you're considering of changing a new phone. And then with the AI, then you thought, oh, okay, maybe I should change it to the better phone that has like a stronger chip in order to run the AI request. So that could be the reason. But apparently, Apple didn't expect it to be so much. And for those semiconductor component, you need to put in your order very early. So that is why they have the supply constraint. So it is going to be a temporary thing. And also the Apple upgrade program right now, they're only rolling it out in the US. So it's unlikely to materially impact the demand, at least in the short term. So I hope that answers your question. And there's another question on cloud. So I'm gonna leave it also for my colleagues to answer, but just on my side, why Google Cloud growth is ahead of AWS and Azure. One thing you gotta bear in mind is Google Cloud, when it comes to size, it's much smaller. AWS is almost twice as big. So even though Google Cloud, they grew about 80+% year on year, if you really calculate it into the actual amount of revenue increase that they have, it's actually still slightly lower than AWS. So you can't just really look at the year-on-year growth as the only determination. And what is the best hyperscalers to buy after the recent result? I would say because I cover Amazon, so I'm still very confident on Amazon because Amazon is trying to differentiate itself a little bit. It's trying to pose itself as the platform instead of just betting on one single model. And I think that is a very smart strategy, especially now with all the China models coming out and they're also running just as well. So that can potentially, if ever there's a new model that comes out that's very cheap and works very well, it can potentially just defeat all the other, because we don't really know what's going to happen right now. So them able to offer as many model as they can, just focusing on being the platform, it's very smart for them in that aspect. Another thing is they're also trying to do their in-house chips, like I mentioned, the Trainium and Graviton, and those are also gaining a lot of traction. So I'm very positive on Amazon right now. I'm gonna leave it there for the other analysts to add on. Yeah, that's all from me. Thank you.
Yeah, thanks, Helena. I'll take on some questions. Few on Qualcomm and Marvell. Any further slide, the recent semicon stocks so badly affected? Yeah, I think Qualcomm will still face softness because I think the memory prices are still increasing. So I think the Chinese OEMs will still stock up, will still decrease their stocking up in terms of the inventory for mobile. Yeah, so I think that will hurt Qualcomm. For Marvell, I think they will do well in the second half, mainly because they are involved in the front end custom AI chips. And I do think that they are able to secure more contract wins with hyperscalers and potentially enterprises who want to be involved in the custom AI space. I think a potential catalyst for the entire sector will be OpenAI and Anthropic's IPO, likely coming up soon in the next few months. Yeah, so that could revive the entire sector. Yeah, but we don't have coverage on these two companies. Just sharing my views. What is my view on Aztec Global's outlook, value play, or track? Yeah, we don't cover Aztec as well. And we haven't had a call with management. So I mean for the past few quarters. But from my external sources, management did guide that the ramp up of the new MPIs will be gradual, and the volume wise is still unable to offset the current volume with existing customers. So results is likely to be soft for the second half of this year. I do think that it is still a value track at this point in time. Yeah. Thanks. Within research, right, applied material, which has a more promising role in the AI race, research and applied material as well. My view for both of these, the comparison between both of these companies is that research likely in the shorter term, which is like maybe 6 months to 1 year, has a better prospects than applied material, because memory companies are trying to ramp up the equipment spending in order to fill up their greenfield capacity, which will likely come online next year itself. So there's a lot of visibility from memory players already. For applied material, it's more of a longer term play, because applied material has a broader portfolio, touching foundry as well. Lam Research also has, but Lam Research is more exposed to memory. So applied material, we do have to wait for foundry to really ramp up capex, which they have been guiding higher capex, but I think memory has, in comparison with foundry, is the one that's guiding a higher capex right now, and we are seeing the equipment spending right now. So I do think that in the nearer term, is still Lam Research is still my preference. Applied material is more of a longer term play, even though both will benefit from this higher spending from both memory and foundry players. Yeah. What to expect from AMD and SanDisk results? What are their valuations? Okay, to answer valuations wise, AMD is about 60, high 60s forward PE. SanDisk, I think it's about 35 times forward PE. What to expect from AMD results? Yeah, we have a coverage on AMD. I do think that their results will be strong because of the continuation of the ramp up of the MI350 GPU. I think guidance will be strong as well. Fourth quarter, I think the next generation MI450 GPU will have a strong ramp, and also their new CPU should likely drive the results performance as well. Yeah, so that's for AMD. We don't have a coverage on SanDisk, but I think generally enterprise SSD demand is still strong. I do think that SanDisk will still benefit from the increasing demand for NAND. Yeah. So that's my views. I think I'll type the rest, hand over to my other colleagues. Thanks.
Maybe I can take one question. So Hashim, does SIA and SETS both provide cargo services? So yes, they do both provide cargo services, but they do different things. So for SIA, what they do is they fly the cargo itself. So if there is a passenger plane, there is going to be some capacity left even after passengers booking their luggages. And what SIA does is to sell that space to make money through cargo revenue. For SETS itself, when a cargo needs to be flown from point A to point B, you need to bring it to the airport. And to keep all those cargo at that place, you need a warehouse. And that's what SETS provides. It provides you with a warehouse to keep all your cargo in that airport. And second, what it does is to move that cargo from the warehouse to the airplane. So you need logistics support and ground handling support. SETS provides that. So given this context, SIA's revenue or cargo revenue might be more volatile compared to SETS because there's always going to be cargo that's going to be stored, and SETS will be able to make money by warehousing their cargo location. I think that's the only question. So I'll pass on to the others.
Yeah, Darren.
Yeah. I've typed in some. I'll answer the others. Yeah. There's one post with many questions. I'll just answer the Maple3 part. One Maple3 vacancy, so that's mainly because of the North American data center portfolio, where the occupancy keeps declining as a lot of the tenants they move out. Probably because those are enterprise users, and also the from what I hear in the market is that the data center the infrastructure needs to be upgraded. So that's also another reason why some of the tenants they do not want to renew. So as a result, there are Maple3 industry that are trying to divest some of these non-performing data centers, especially with elevated vacancies. Yeah, so that's why the vacancy is high for Maple3 Industrial Trust. On MPAC, expect some divestments of their China properties to happen in view of the continuous poor performance, which is a drag to impact overall results. Yeah, so for China, of course, if they have a chance, they will be trying to divest that. That's also the case for many other of these REITs or property companies where they're trying to divest China or exit from China. But the issue is that there is a lack of buyers and the valuations keep decreasing also. So the bidder spread is very wide. So if you're selling now, you're probably looking to sell at distress levels. So that's also why a lot of these non-performing assets are being held on to by the REITs and property companies. Also, the absence of buyers as well. Yeah, so that's a challenge, right? Whether you want to divest at a huge discount or you want to keep the asset and wait for it to recover potentially within the next few years. Yeah, so it's very challenging. Yeah, but definitely the poor performance for these Chinese assets will be a drag. Something wrong with my cam. Yeah. Taking into account the current asset holdings and past performance of the REIT in the last many years of interest rate movements, which SE REIT do you think is the least affected by interest rate movements? Well, this is a very tough question, CK. I think for this you have to look at really the percentage of hedge rates. So those REITs with have a internal policy to hedge a higher percentage. So probably 80% will be a very stable number or a very number that will leave the interest cost relatively not so volatile as compared to others with a high percentage of floating rates. Yeah, that's what I'm trying to say. So yeah, if you're looking at which REIT is least affected by interest rate movements, that's definitely those with a higher percentage of hedge rates, especially their current rates as well as their internal policy. Yeah, because some REITs perhaps their internal policy could be 50% to 80%. So that is a quite a wide range. So sometimes if they hedge 50%, then you are going to see some wide swings. And if they hedge 80%, then you're going to look at it as less volatile. So you have to look at their internal policy as well. If you are looking like, I mean, this is for the very long term, which REIT will be less impacted by interest rate movements. Yeah, it's a good question. Notice CLAS reported a significant decline in revenue and profit. Given this result and the current geopolitical situation, could you give a better understanding on your current buy rating and thesis? Yeah, so for CLAS, the decline in revenue and profit, that's mainly driven by, I mean, it's not really declining. It is a decline in revenue, the top line, because of the absence of contribution from some of the assets that are undergoing AEI. So this is really expected, as they've already mentioned that they will do to improve the quality of the portfolio in the longer term. In the near term, when they have some assets undergo asset enhancements or redevelopments, so there'll be an income gap or loss of income from this downtime of these assets. So this is already partially expected. But for DPU wise, it is stable. So they are going to use previous divestment gains or retained earnings to top up this DPU. So in this quarter, actually, their distributor income it grew. I can't remember the amount, but high single digit % if you are just looking at distributor income. And based on that, they retained about almost 10 million to keep the DPU stable. So most of these gains in this quarter was from non periodic items. So that's when they pay off some of the loans and they get some FX savings. So that is partially where some of these gains are from the distributor income. So their core earnings is down also mainly because of some one-offs and the absence of contribution from the AEIs. So once these AEIs complete and they start contributing, there was a estimated DPU uplift once the major AEIs complete and the redevelopment of the Somerset Lang Court to Somerset Clarke Quay that complete. So on the stabilized basis, we are looking at like a 0.5 cents DPU uplift. So currently the CLAS's DPS is about 6 cents. So if you are looking at 0.5 over 6, that is quite a significant DPU uplift. Yeah, close to 8-9% DPU uplift for the AI. So that is the thesis. But looking for like based on the current geopolitical situation, so far we are seeing the RevPAR generally hold stable, assuming on a like-for-like basis, because if you calculate RevPAR based on those assets that are taken up for AI, then of course it's down slightly, down 2%, but if you on a like-for-like basis, it's up 1%. So we are expecting RevPAR to remain stable. So that's mainly by occupancy that is improving slightly. So quarter-on-quarter is up about 1 percentage point. ADR likely to hold stable. So given this outlook, we think that's why we keep our buy rating, and on a longer term perspective, DPU growth is intact. So that is our investment thesis for CLAS. I hope that clarifies. I think I saw one more. Please comment on the prospects and dividend yield for iREIT, Daiwa, House Prime, and Core. So for iREIT, the Berlin campus that remains an issue, so that the DPU growth will remain challenging. For Daiwa House also, the yield, can't remember the yield, probably 6%. But for Japan, because even though there's inflation and some landlords are trying to, or rather most landlords are trying to price in a rental growth or rental escalation in the portfolio, but the tenants are still not very receptive to that. So that still remains challenging to try to boost rents. So for that's DHLT also, and in the face of rising interest rates in Japan also, that remains a headwind for that. For Prime and Core, Core, they just released their results at about 21% payout ratio. So for Prime and Core, if you are looking at dividend yield growth or DPU growth, that really depends on, of course, the underlying performance as well as the amount of DPU that they will, or rather the payout ratio that they start to, or rather their payout ratio policy. So for Prime, as of end of last year was 65%. For Core is about 20%. So if you are looking at the uptick in DPU, that will really come from the higher payout ratio. Of course, a better operating performance will help with that. Yeah, I think that's all. Yeah, hand over to colleagues. Thanks.
Yeah, I think there's a lot of questions on this Maple Tree, Harbourfront development. Maybe Darren, you want to address this?
Uh, yeah, let me take a look at that. I'll get back.
Yeah. Okay. Thanks. Let me just try to take some. I think there's some question on Seatrium big volume recently. Any views? Yeah. Okay. We don't cover, but I think there's expectations of the P88. Not to confuse everyone. So any P88 is the Petrobras series of FPSOs. If you recall, maybe I think 2 years ago they got this very big, huge surge in contracts because of the P. I think three. Sorry, forgot the exact number, but there were a few FPSOs that they secured, the P84s and so forth. But right now, there's expectations of the smaller, but maybe 3 to 4 billion P88 that could be announced soon by Petrobras, and the P91 probably they will announce next year. The second reason why market might be optimistic on Seatrium is, of course, the results was they perform well. But the other thing is that so I'm trying to say, okay, they got a huge cost savings because they divested a company where they can hit almost 50 million of cost savings. I think that's what they guided. And first half they probably only reach 5 or 10 million of these cost savings. So that give visibility of a very strong second half. The third point is also there's also expectations of more contracts also from Africa, especially from the FLNG, especially the Gola FLNG. I think that could be worth almost 1.5 billion. But having said all that, Seatrium is running on a 10 billion revenue. So even if they, because some of it are repair maintenance, so even if they need to secure my a guesstimate maybe at least 7 to 8 billion of new contracts a year just to stand still. Yeah, so they need to run 7 8 billion a year just to stand still because that is the revenue run rate. So having contracts might probably help push the share price in a very near term, but they need much more than that to at least grow the revenue. Otherwise, you can say the revenue is more or less peak either this year or next year. Yeah. Okay. Hope that helps. Why Sheng Siong valuation so high now? I also not sure why so. So I think the results, of course, did much better than. I mean, the growth has accelerated far better than the last 2 3 years after the pandemic. And one thing has changed in the environment is there's less competitors. How much is in trouble? Ammo, is it Ammo? There's another. Of course, Giant has exited the market. So compared to maybe five or pre-pandemic, or the competition has basically, I won't say wiped out, but the competition has just definitely retreated quite significantly. So for that reason, you can argue that their valuation should be higher than the past, but 28 times, I'm not sure how high can it be because this is at COVID time when all the grocery shares were running at the very strongly. So yeah, that could be one reason. Um, okay. Let me answer this last. Then we go to the technicals. Do you expect strong second quarter earnings from Singapore banks? Any new target price after the recent pullback? Actually, we're a bit concerned about the way the banks have run. So even second quarter numbers are good, but I don't think it'll be like you're not talking at most it'll be I think for like DBS the expectations is flat earnings, slightly down. So at most if you push it up also the upgrade might be only maybe 5 percentage points or so forth. Probably UOB will be probably the worst performer the expectations in terms of the earnings. So we are more in the rotation camp, rotate out of banks into the other large caps because I think the run up is pretty steep. Yeah, I know that's our view. Glenn is on reservist. I can't answer. Hand it over to you, Zain, then the rest I'll just type it in. Yeah, thanks.
Yeah, thanks, Paul. I'll move to the technical. So let me share my screen right now. And so first question is on StarHub. Yeah, so for StarHub, after the share price was a bit of a run up recently. So I think for now it's probably at a bit of a resistance at this 112 to 113 level. I expect some slight resistance over there, perhaps some consolidation again. Because previously this was as you can see the chart during August to about December last year, there was a period of consolidation over here, about 112 to 113. There was a resistance over there. So I think price could stall slightly over there and just do some consolidation, and with the support at 108, 109, which was the level price tested at the start of last week and managed to hold over there. So probably some range bound movement for StarHub, I feel. Next one on Ultra Green. And so for Ultra Green, I think something to note is that price did a double bottom recently at 118 over here, and some bullish divergence. As we can see, the momentum indicators is a higher low being formed, but I think whether it gets out of this downtrend, right, I think we still need more confirmation. In terms of you look at the weekly chart, I think price is still generally under this 10 SMA on the weekly, which is about 128. So generally we can see since this decline from start of March, I think price has been generally holding this 10 SMA weekly as a resistance. So price hasn't broken out of this level yet. So I think for now still there's probably some sideways movement, and we've also upper Bollinger Band about 128 right now. So there could be some resistance. I expect the stock to maybe just do some sideways movement. For now, we support about 121 to about 122. Yeah, then we likely just consolidate sideways. Then if you can break out like 128 in about a few weeks' time, then I think we could see a bullish reversal upwards for this counter. Next one on 3988 is Bank of China. Yeah, so Bank of China, I think very overall it still maintains in the uptrend, so very steady this counter. Then recently there was a run up to actually retest this resistance, this swing high level at 545. So I think there could be some slight pullback from this area of resistance. But I think price will probably just do some sideways consolidation. I think support about 538 with the swing low on Friday as well as the 10 SMA level. Yeah, so I think we could maybe take reference from like this part February this year where we tested the highs and price just did some consolidation, maintaining at the highs. Yeah, so overall still uptrend, but I think currently hitting a resistance area that we are likely to see some sideways consolidation. Next on some of the US counters. So first one on Apple. So Apple dropped close about 7% down after the results. And then I think currently we are likely to see some rebound first for the share price. I think because price is at the lower Bollinger Band levels, so that's about 304, 305. So I think we are likely to see some rebound, and coupled with that, price the lower week on Friday also retested this horizontal level at about 300. So that's held steady, and price is can hold 307. I think we could see some rebound towards about 315, 360. I think that's the likely to be a resistance. And when we wait for the short-term averages to slow down, I think that holds a real resistance as well. So it's probably some technical rebound in the short term. The weekly chart also retested the 50 10 SMA 309. So probably some slight technical rebound. Then I think we'll probably face some resistance at 315, 316 over there. Then I think the stock could trade sideways in the near term. Next one is SOXL. So this is the 3 times semiconductor bull ETF. So for this, I think as mentioned for the semiconductor index stocks earlier on, I think we should be able to see a further rebound. So first up, I think I think the share for this 3x ETF price also there's a bearish trap where there was a brief breakdown below 104 this level, and then price also retested. Another thing is that price also retested this purple line, the 200 SMA level. So there's been really a very big correction downwards from the peak. RSI also hit on 33 last week. That's quite near the oversold level. So there was a first wave of rebound towards the 131 10 SMA level. So we could see some I think we'll see some slight pullback over here, but I think price will likely hold support of 111, 113 about there. Then I think we could see, then we are likely to see another wave upwards to try and test higher resistance level like the 20 SMA about 150 to this swing high 166. That's the next area of resistance. So I think yeah, we'll probably see some pullback from the Friday highs and then a higher low being formed and then try to challenge the higher resistance levels. Yeah, so that's like a ABC with rebound after the correction. Next one on NVIDIA. So NVIDIA generally, I think, still keeping the range. But price action wise, it still generally hasn't regained a lot of bullish momentum yet because price is still under this 212 very key level. This was the all-time high, the previous all-time high back in October last year. And since price tried to break out of this level, it has failed to maintain it above ever since start of June. So this is still a key recent level price is unable to get above 212. And what we have seen recently is just a range bound consolidation, 192 to 212. So price last week we tested the support and did a bit of rebound. I think this week wise, we are likely to see some sideways movement. I think, with a resistance at about 203 to 205. This area over here, and then some sideways. I think support will likely hold about 197, 197 to about 199. Yeah, so I think just most likely is a sideways movement for the time being. Next one on Alphabet. And so for Alphabet, I think last week price action was positive after it managed to on Monday onwards, it managed to open above this 324, 325 level, and then a recovery to first retest the 10 SMA level. There was a slight at 337 and slight pullback and rally on Friday. So I think for this week, start of this week, I think we could see some pullback first because price is back at this 50 SMA level, this green line, which has held as which was a bit of a resistance 7 July as well as 15 July. Then on the weekly time frame as well, it's doing a retest of the cluster of short-term moving ranges at about 347, 355. So I think it's like a bit of a slight mean reversion. Then we could see some resistance come in first, but I think support will hold at a higher low. About first of all level 348 about there. Yeah, then 340, 342 to 348. And we could see some sideways movement and yeah, for this week. Yeah, for TJs, I think overall, even though price is consolidated at highs, I think there's been a bearish divergence. You can see in the weekly time frame, momentum is actually coming down. So I think it's a range it's a most likely a range consolidation, but it's some you can see not very strong bullish momentum. Potentially head and shoulders as well. A key neckline support about 146, 148. So currently I think we could be at the right shoulder area. Price recently retested this breakdown level 163 and then some pullback over here. So I think first retest of this level 157, you could see some bounce. Given that this is an area of resistance breakthrough, price broke out recently. So when we see a bounce over here, there I think resistance might come in at about 161. Yeah, then we could see some sideways again. Yeah, if price breaks below 157, then we are likely to see some further weakness afterwards to test for 154, 155. So most likely still kind of range bound for TJs, but I don't think price will I don't think price will break above this 163 in the near term. Next one on Capital and SIA. So for Capital, I think in terms of the trend we're seeing right now is this is trading within this hours channel. I think it's quite important to hold this $11.10 level, given that it's the channel support. And on the weekly time frame, this is where the 10 SME as well as 20 SME weekly are at as well. So this is a very important level to hold. Right now, most likely, I think we'll see some sideways consolidation after the sell down after the results. With near-term resistance likely to hold for about 11.35 to 11.60 this area. So most likely, I would say a sideways movement from 11.10 to about 11.60 right now first, yeah. Then important to hold 11.10, but we could see some further, we could see weakness towards about 10.80 next, yeah. If the support doesn't hold. Next one for SIA. As for SIA, I think we are still seeing what we are seeing now. I think most likely is a flat consolidation after the earnings. I think we saw there was a hammer being formed over here. So price is still retaining the support at 750 and all that. Then the Bollinger Bands, if I pull out the Bollinger Bands, it's a very flattish right now. So it's about the bands about 750 to 784 right now. So I think that supports the range most likely supports a range consolidation right now. Yeah. So I think we'll just see price move sideways, continue to move sideways for now. Yeah, the weekly time frame also supported along the weekly 10 SME about 748. Next one, I'll move on to Corning, as well as DRAM, the DRAM ETF. So for Corning, in quite a big pullback recently from the highs. After the earnings, there was a gap down, but a recovery where it formed the hammer at there was an area of support, 122. So first, there was a reverted back to the daily 10 SME about 144 and some pullback over here. But I think for now, I think start of the week, we likely still see some resistance about 144 to about 152, this area, given that this was a breakdown level in middle of July. Then I think price will likely form a higher low about at 135 over here. Then it could do some range bound consolidation afterwards. Yeah. On the weekly time frame, I think this also is deviating quite far from the 5 SMA weekly, about 165 right now. So I think most likely we'll see some I think price will likely hold higher low and try to rebound, at least in the near term, given the sell down across. Yeah. So and next one for the DRAM. DRAM ETF, I think so price we tested the swing low 46 about 46 last Wednesday, and then a rebound to test the 10 SMA level of 53. So I think it will hold a bit of resistance, 53 to 56.50 this area first, where there's also 20 SMA level. I think price will form a higher low with support. I think for now it's about 48.70 to about $50 about here. Then we could see some sideways movement or try to retest the next resistance at $59. Yeah. I think price action wise could be quite similar to the semicons index as well. I think it's about 1 o'clock. I think I'll hand the time back to Paul or my colleagues if there's anything more to add on. Yeah, thanks.
Yeah, thanks. Really hit one. Yeah, there were some questions. Let me just try. There was some on the M1 and StarHub merger. I think this one's really flip a coin. The reason why is we think what's the likelihood of M1 StarHub? I think from Keppel's point of view, they want to do all this cost cutting so that they look prettier before they marry. But of course, the parents want this arranged marriage. So that's why it's not such an easy decision. There's probably a lot of back and forth between the parent that wants the arranged marriage between StarHub and M1. But I think Keppel is trying to do very aggressive cost cutting, restructure the get better numbers, then only do this M&A. So that I think are the moving parts. So it may not be so easy. It may not be so immediate at my own point of view, because I think he probably doesn't want to do that. You mentioned OCBC, other mid-cap stocks. Have you the potential of the two banks as a mid-cap stock didn't go up? No, I was just kidding. I was just saying that, for mid-cap stocks, there's usually higher risk, less volume. So I'm just kidding in the sense that you don't have to think so hard or something. Just buy the banks could probably outperform the small mid-cap. So that's what I was coming from. Sorry, it was meant to be a joke. Yeah. Any uptrend on the outlook for Vilma? I can't comment on Food Empire, but for Vilma, we think it will be quite weak, the results, because you look at what's happening in China. The hog prices are at I don't know, 10-year or 15-year lows, and this could impact their soy crushing business. And also their edible oil, the Chinese consumer not performing well. So I think China will be the weak spot for Vilma. Okay, I think with that, thanks everyone. Already crossed the one. Thanks everyone for your time and especially for all your questions. I hope it was useful and hope to see you again the following week, because on the 9th there'll be no webinar. Yeah, thanks. I think you should have mentioned it earlier. Okay, thank you everybody. Bye. Thanks for your time.